All right, welcome back. You are listening to another episode of the Mark Moss Show, where we talk about the decentralized revolution. We talk about Bitcoin. We talk about cryptocurrencies and how it is changing the world right before our very eyes. Of course, we look at it through the lens of politics, finance, and technology. And man, it is a fast-changing world. We can see the world literally changing right before our very eyes. And so it's important to keep your eye on the ball if you want to understand where things are going, if you want to anticipate where things go next so we can navigate these the right way. And one of the big things about Bitcoin and cryptocurrencies that we hear all the time is, oh, just wait until the governments regulate it, right? We hear that all the time. And everybody's just waiting until it's regulated. And I'm like, well, did you realize it's already like the most regulated asset that's out there? Most people have no idea. They think, oh, just wait, they're going to regulate it. It's like, it's already regulated. It's already the most regulated asset. So what do I mean by that? Well, Bitcoin is regulated by the IRS, right? So they have guidance over it. It's regulated by the SEC, by the CFTC, Commodities Futures Exchange. It's regulated by FinCEN, the Financial Crimes Enforcement Unit. And so all of these federal agencies, all of these bodies already regulate Bitcoin. You don't see that with other assets. So, for example, equities, like a stock, for example, is regulated by the SEC, but it's not regulated by FinCEN. It's not regulated by the CFTC, only by the SEC. But yeah, Bitcoin, we have every single body, every single regulatory agency has already exerted their power over it. And we're seeing this more and more, and we're starting to see like this power struggle of, well, who ultimately is going to regulate Bitcoin and cryptocurrencies? And so we've started to see recently quite a bit the SEC, Securities Exchange Commission, headed by Gary Gensler, has started to become much more vocal about it. But they're doing it from a place of really kind of working behind the eight ball. So instead of driving it, they're kind of trying to catch up. And by doing that, it's kind of leaving this ambiguous tone over it and almost making it so vague that it looks like their powers could almost extend to the entire space. But the other regulatory agencies maybe aren't okay with that. And I think it's time to try to get some clarity as to what's going on. And that's exactly what we've been seeing. As a matter of fact, we see there's a U.S. Senate bill. So the Senate has put a bill together that will give the CFTC, remember that's the Commodities Futures Exchange, give the CFTC crypto market oversight. But it doesn't say how much. So the Senate is trying to come forward and say, hang on. Like, you guys are making this way too messy, way too difficult. We need to get this cleaned up, clarified so we can move forward. So they said that the Senate bill they're trying to put through would give it to the CFTC. That's what they're saying. The measure would make the Commodity Futures Trading Commission the watchdog for most, that's a key word, most of the market. But it doesn't define whether tokens are securities or commodities. And so that is the crux of the argument. Are tokens securities or are they commodities? So Gary Gensler, SEC, has been pretty clear. It's been, and before him, his predecessors, it's been pretty clear that Bitcoin is a commodity. Bitcoin is not a security. It doesn't meet any of the criteria of a commodity. Doesn't meet the Howey test, which is the test they would define, test to see whether it is a commodity or a security. They thought Ethereum, they said that Ethereum probably was a security, but then could have evolved into a commodity. But now Gary Gensler is starting to say that, maybe, I don't know, Bitcoin could still be a security. And then he said pretty much every other token is a security. Now, they haven't actually put out formal guidance on this. Of course, we're starting to see some problems that Coinbase is going to have to deal with, so we're going to see how this shakes out. But that's the crux of the argument. If it's a commodity, then it goes to CFTC. If it's a security, then it goes to the Securities and Exchange Commission. It says here, the latest U.S. legislative effort to steer most crypto oversight to the CFTC has bipartisan support. That means both sides of the aisle support that, but does little to answer the crypto industry's top question, which is, what's the top question? What makes a token a security or a commodity? Now, again, we have pretty clear guidance on what a security is. We have the Howey test. The problem is we have a 100-year-old rule trying to fit a brand new technology that's a lot of things that we don't even know what it is yet. And so the problem is that you're using this old, outdated scale to try to measure something that doesn't neatly fit into that. And it says the legislation from the leaders of the Senate's committee would require crypto firms involved in the trading of assets like Bitcoin and Ethereum to register with the CFTC as their primary regulator, something industry leaders such as FTX co-founder Sam Bankman-Fried are cheering from the sidelines because they all want some sort of clarity. Look, we can't be hearing from both of you. It's like a child having two parents, and one parent says yes, you can do this, and the other parent says no, you can't. Like we need clarity. We need uniformity. We need to know what the deal is. It says the bill would grant expanded authority to the CFTC to oversee crypto spot markets. It relies on the courts and the Securities Exchange Commission to set the boundaries for which tokens may be considered a commodity. So the problem is that we're trying to get this Bitcoin spot market. We want to be able to have these new ETFs, and they keep getting shot down. But they want to grant this to the CFTC as opposed to the SEC. It says right now there's really a patchwork of state regulators and no federal agency to conduct oversight over the cryptocurrencies. And we know that needs to change. And so that's exactly what they're trying to change. Now, it's not just in the United States they're trying to do this, as a matter of fact. We see this happening overseas as well. Of course, in Europe, the European Union, as well as the UK, they've been really trying to figure out what they want to do with cryptocurrencies as a category, trying to pass all types of new laws on the ways you can take custody of it and so many other things. But there's a new piece of news that came out this week as well, which says Law Commission of England from the UK proposes new form of property for Bitcoin. The proposal from England's Law Commission outlines a new form of property for digital assets and a framework for legal proceedings. And so what they're looking to do is something similar. They want to have a new category of property, which, remember, property would be a commodity, not a security, that encompasses digital assets such as Bitcoin. And it could change the way the United Kingdom interacts with and recognizes Bitcoin. All right. And so they're trying to reform this legal structure. So again, we have these old, outdated laws, 100 years old, and it's trying to somehow come up with guidance or regulations on brand new technology that's neither of those things. Sure, it's kind of like this, yes, but it's also kind of like this, and it's also kind of like this, and I guess you could look at it that way, but you can also look at it this way. So it doesn't neatly fit into any one of these packages. And in my opinion, it's a massive mistake to try to regulate it with 100-year-old thinking because, again, we didn't even have the internet back then. We didn't have any type of communication back then, really, right? And so we didn't have the internet. We certainly didn't have new forms of communication that we have with the internet. We didn't have new forms of money, new forms of value, and we do today. The other problem that I have is trying to take those old regulations and try to apply them to brand new technologies is it boxes them in. So new technologies, like when electricity first came out, the first application of electricity was a light bulb. So electricity can only be a light bulb then. Well, can it also power my house, and could it also charge my vehicle? Nope, it's only for a light bulb. That's all it is. And so that's kind of what they're trying to do. They're trying to take this old, outdated thinking model 100 years ago and then apply it to a brand new technology that would then box it in and limit its potential. We don't know the full potential of what Bitcoin and cryptocurrencies can do at this point. And we'd certainly like to find out. Now, they may not want to find out because they're afraid. We've seen Christine Lagarde come out and say that innovation is a threat, she said. Innovation is a threat to our financial stability. But we can see here in the United States, U.S. Senate bill is trying to redefine it, give it some clarity. The UK is doing the same thing, trying to, as they say, clarify a new form of property for Bitcoin. So I would love to see the government just stay out of it, but that's not the case. But maybe this will help. But I like this one article that came out I saw here. It's written by Jameson Lopp. He's the co-founder and chief technology officer of a Bitcoin security company called Casa. And he is someone who's been around the Bitcoin space for a really long time. He previously served as a software engineer at BitGo. And he's been in the space for a long time, writing about Bitcoin and cypherpunks and so forth. And he put out an article this week that I thought was pretty good. And it's titled, What is Crypto's Downfall? And he says it's the complexity. So the complexity is the downfall of crypto right now. Now, I've been talking a lot about this evolutionary process that happens. And so just because something's difficult in the beginning doesn't mean it will always be difficult. In the very beginning, in the early 90s, it was very difficult to get your computer to go online. It was very difficult to go online. Of course, today it's easy, right? All phones are just connected. You just hit a button and you're online. But it's very difficult in the beginning. It doesn't mean it will always be that way. But he's saying that the complexity could be the downfall. And he's saying how, in a lot of financial markets, we've seen a lot of values plunge this year in the Bitcoin and cryptocurrency space. We saw that happen big time. I've talked about that extensively on this channel, starting with Terra Luna, and the Terra Luna stablecoin blew up, and then everything kind of dominoed from there. But as these things happen, it causes a lot of problems. And a lot of new people that jump into the space get, as we would say, wrecked. They didn't know what they were doing. They got brought in by greed. They didn't spend the time to understand what the differences are, what they're putting their money into, and they got wrecked. I'll be the first to tell you, don't ever buy anything. Don't ever invest into something that you don't understand. You've worked very hard for your money. You should work equally hard before you figure out where you want to put that money. And he says that the warning signs were there for those of us who have been around for more than one market cycle. So what we can see is that the price of Bitcoin and cryptocurrencies goes up, and then it comes back down. And we have these long bear markets, or these cold winters as we call them. So for example, we saw Bitcoin run up from $1,000 in the beginning of 2017 to almost $20,000 by the end of 2017. And then 2018, 2019, and into 2020, it just did nothing. And as a matter of fact, it went lower, lower, lower from 20,000, dropping as low as almost about 4,000, just below $4,000. So those of us who have been around for more than one market cycle, like me, we're kind of used to this. We've seen this happen. It doesn't make it easier. But for people that have just jumped in, they don't understand that. And he says that the reality is that each project is its own unique animal. Not all of them are built to withstand the myriad threats that lie ahead. So each of these projects has their own attack vectors. They're all projects, and they're all experimental, and there's lots of problems that happen. And he says that what's the difference of experiments, pipe dreams, and scams? Says when Bitcoin started in 2009, it was a league all on its own. Since then, it's emerged as a store of value, a censorship-resistant network. The market cap got up to $1 trillion. Even with the crash, Bitcoin's potential seems really bright. But he says the problem is all these projects that have followed, there's more than 20,000 cryptocurrencies, digital assets, tokens, projects, etc., all promise to be the future of finance. And each takes some elements from Bitcoin's design, blockchain, decentralization, economics, mining, cryptography, but then they all alter them in some way. So we have something that we know that works, and now everything else is an experimentation off of that. So we're going to try something different, which is going to give us trade-offs. It's going to give us more of one thing, but it's going to give us less of another. As a technologist, he says, I appreciate the experimentation that takes place in crypto. I'm less interested in the hype. He says that new projects are always risky, regardless if the people behind them are well-intentioned or not. There's a website called deadcoins.com, and it tracks projects that have folded up and currently lists over almost 2,000 coins that have just folded up and are gone. A lot of them are also gone. They just don't actually report that they are, which isn't surprising because we know what 9 out of 10 businesses fail, right? But it says that most projects will be unrealistically optimistic, but the only way to test if an idea works is to try to build it and see what happens. And that's kind of what's happening. So all of these projects launch, they raise a bunch of money, they get everybody hyped. He says he's less interested in the hype, hyped up, and then they see if it works. And unfortunately, in most cases, it just doesn't. He says when people get interested in, quote, cryptocurrency, they often feel compelled, like they missed the boat on Bitcoin, and so they're trying to find, quote, the next Bitcoin, whatever that means. I've made a video. You could search Mark Moss, the next Bitcoin is, on my YouTube channel, and I answer that question. The next Bitcoin is Bitcoin. But everyone's trying to find that. They missed the boat. And it says entrepreneurs quickly wised up to the fact that if they issued new coins, then they could try to capture on that sentiment of these people that want to get that next Bitcoin. Now, what does that mean? It's too late. I mean, I don't know. I've missed the boat. I don't know what that means. Bitcoin still has so much potential. As a matter of fact, I believe it's a better risk-adjusted return today than it was when I got in 2015. The siren song of centralization. So he says, if you've been the victim of one of these schemes, I suggest using this bear market as a time to reflect and learn about the underlying technologies, and start with Bitcoin, because Bitcoin has the proven track record. All right. So while we're in this bear market, like I said, we saw in 2018, 2019, and most of 2020, is take the time to learn. Invest into your own education. Research this. Start with Bitcoin. Bitcoin has the proven track record. But the real thing, and this is what I say, I'm not quoting off the article, the real innovation here, the real technological revolution that's happening is decentralization, which is why I talk about the decentralized revolution every day, is decentralization versus centralization. So what happened with the internet is the internet allowed us to have all these decentralized voices. So now anybody can create content, anybody could post stuff, we can communicate with all these different people. But at the same time, it also centralized everything. Because in the beginning, as I said, it was very difficult. So to go online was very difficult. To build a website was very difficult. As a matter of fact, in 1999, I had a buddy who had this great idea to build this new internet business, a .com business. At the time, it was going to be a website that allowed you to go shopping and then get a percentage of all your purchases, and they would be donated to a charity of your choice. Now, that doesn't seem like a unique idea today in 2022, but in 1999, I can assure you it was. I don't think there was anybody doing it at that time. And so, man, we just knew if we put this .com on this business and we launched this, we were going to raise so much money, we were going to get rich. But the point of the story is that it was not easy to build a website back then. There was no Amazon Web Services. There was no cloud hosting. There was no HostGator. There was none of that. So if you wanted to have a website, you had to host it yourself. And we had to build our own servers in my office. I'm going to explain more to you about that and talk about this decentralization. And I was talking about how in 1999 we started this business, and it was this web business, and there was no cloud hosting. So we had to set up in my office our own web servers. And so I had this rack, and it was sitting in the corner of my office, and we had these two servers in there, and they had these hard drives. They were called RAID 5. They were hot swappable. You could just pull a lever, pull the hard drive out, swap another one in. You had to do that because the server had to be up all the time. And if anything happened, you needed to be able to just swap it out real quickly. It was all redundant, etc. So it was very difficult to get a website going at that time. Today, super easy, right? You go on Wix and just click a button and have a website. Simple. So it got easier over time. But also what happened is because it was so hard to run those servers, Google stepped in and said, we'll be your server for everything. We'll run your email, and we'll run your docs, and we'll run your spreadsheets, and we'll run your everything, right? And Facebook, and now Facebook comes in, and we'll host your videos, and we'll host your pictures, and now Google and Facebook both stepped up to be your ID. So now when I log into websites, I can sign in with my Google ID or sign in with my Facebook ID. And so the internet became very centralized. It all got centralized because of the trade-offs, right? I want convenience, I want speed, I want security. So rather than me try to set all this up on my own, I'll just let Google do it for me or Facebook do it for me, all right? But just because it was difficult in the beginning doesn't mean it's always going to be difficult. So now it's much easier to run my own website if I want, etc. And so we're starting to see this pendulum swing back. But what's changing now is back to decentralization. So that's the real revolution here. So instead of having one database, like a Facebook database, now we have many databases. That is the difference here. So the real revolution is decentralization. Now, in order for something to be decentralized, you can't just have one database. You have to have many databases. And in order for it to be really decentralized, everybody should be able to run one. And that there, to me, is the big difference. You need to be able to run a node to participate in the network. And that's where the problem is. Bitcoin has a very small database. Anybody with a 5-year-old laptop can download the entire database and run a node. But the other cryptocurrencies can't do that. So what happens is there's trade-offs. So over the years, many parties have sought to improve upon the Bitcoin design in various ways. Some tried to increase the number of transactions. Others went to get faster transactions. A number of projects have tried to plug other data from the real world into a blockchain to create sophisticated markets like derivatives. These efforts have struggled to overtake Bitcoin as the dominant store of value because they usually introduce some form of centralization. Why? Why does it do that? Well, because centralization is highly efficient, but it undermines your efforts if your goal is to democratize finance and empower individuals. So the real revolution is decentralization. But the problem is that every time one of these people tries to make it faster, make it cheaper, put a bunch of stuff on top of it, derivatives, etc., it starts to centralize it, which is exactly what we're trying to get away from. Centralization hurts projects because it tends to corrupt incentives for their respective communities. For instance, an altcoin project might make it hard for everyday users to run a node and participate in the network. Exactly. So anyone with an old laptop can run that, but can you run a node and participate in the network for Ethereum or Cardano or XYZ, fill in the blank, Solana? The answer is no. They make it almost impossible to run a node and participate in the network. Or you could create an inner circle of validators as gatekeepers of transactions. So now they use things called governance, and so now there's staking, and so now people get to vote. And so they could easily create this circle of known validators or gatekeepers that can feed into the blockchain. And that creates a single point of failure that could happen through bribery, collusion, outright attacks, etc. So Bitcoin's success has been predicated on its decentralization because users can participate in the network without having to trust one another. So Bitcoin is open. Anyone can just see the code. It's permissionless. You don't need permission to join. Anyone can just grab a computer and jump onto the network. You don't have to trust anybody. It's trustless. And so because of that, you don't have to trust anybody. You don't have to trust anybody else. You don't have to worry about people colluding or collusion on voting. Instead, you have to trust the network protocol rules, and that's it. The decentralization is why Bitcoin has grown as a form of money. The problem is now getting back to the complexity. So the complexity is the problem that seems to hold people off. But again, it's not something that just starts instantly from day one being the easiest. As a matter of fact, it's an evolutionary process. So we try different things. These things work. Things didn't. Let's try something else. We get feedback, etc. So we want to have something that's simple. The problem is the complexity increases the risks that are involved. Complexity increases risk for users. So what we're seeing over and over and over, for example, is we're seeing just this week we saw massive hacks happening on the Solana blockchain again for who knows how many times that's happened because of these complexities. So all these different wallets, all these different yield farms that are set up, etc., create all these data points that could be hacked, or what we call attack vectors. Now, the way that you would want to solve that is by taking custody of it yourself and holding it on your own. Now, one of the oldest problems that mankind has had is how do I store my wealth? How do I store my value in a way that can't be stolen from me? And that's one of the things that Bitcoin has solved. So now Bitcoin, I can easily withdraw it from an exchange. I can custody it myself, and then I don't have to worry about anybody stealing it from me. Another article came out this week that said, but self-custody isn't for everyone. This dream of being your own bank maybe isn't for everybody. It says, as self-custody puts a lot of responsibility on a user, many find it way too uncomfortable or too hard to handle. Well, again, just because it's hard before doesn't mean it will always be hard. It says, some experts believe that self-custody is one of the genuine purposes of crypto. The way of storing coins is not really suitable for everyone, according to an executive from Wisdom Tree. And I would push back on that. So there's a spectrum of security. How secure do you want to be? I can hold my gold at my house and I can put it under my mattress. And, most people aren't ever going to see it. Most people don't break into my house. It's pretty good. If I want to get better, I can put it into a safe. If I want to get better, I can get a really big safe. If I want to get even better, I can get that safe and I can drill it into the foundation of my house. If I want to get even better, I could build a dedicated vault. If I want to get even better, I could get a dedicated vault with armed guards outside. And you see, so it's a spectrum of how you want to secure that. You can easily pull your Bitcoin off an exchange and custody it yourself as easy as you could use Venmo. If you know how to use Venmo, you can do it yourself. Now, that might be good for a little bit of Bitcoin, like it might be good for a little bit of gold under your mattress. The more Bitcoin you have, the more you would want to invest into your security, just like the more gold you'd have, the more you'd want to invest into security, sort of like I said. But you can start small, you can start easy, and you can work your way up. And like I said, if you know how to use Venmo, you can do it. You can go onto the App Store of your phone and you can download any number of wallets for Bitcoin. I like the Moon wallet. I like Blue wallet. Those are two that I like. But I wouldn't hold any more on that than I would carry in my wallet, my billfold, as I walk around town. The rest you want to put into deeper forms, better forms of security. And then I would think of hardware wallets like Trezor or Cold Card. And then if I want to go even bigger, then I would think about multi-signature setups that you could find with Casa that, like I said, wrote this article, or with Unchained Capital. So those are some things that I would think through. Hopefully that helps out. You're listening to The Mark Moss Show. We're talking about the decentralized revolution, talking about today this evolutionary process of how things go from complex to easy. And hopefully that makes sense for you. Like I said, if you have this imagination, you can take advantage of this today. But man, big news happened this week as we saw the two titans, the two big heavyweights in their respective spaces joining together. Now, is this a good thing or is it a bad thing? Well, I guess it depends on which way that you look at this. But the announcement, I saw it on every news source out there. On Bloomberg, it says that BlackRock, everybody's favorite asset manager, $9.5 trillion in assets. Let's see. Yeah. BlackRock teams up with Coinbase in the crypto market expansion. It says partnership will help clients oversee their Bitcoin exposure. But it says at the same time, Coinbase is facing an SEC probe over trading of digital tokens. That's a whole other story. But BlackRock Inc. is partnering with Coinbase Global Inc. to make it easier for institutional investors to manage and trade Bitcoin, taking the world's largest asset manager, which is BlackRock, into the Bitcoin market by partnering up with Coinbase. On that news, Coinbase's stock, Coinbase is a publicly traded company, and their stock has been completely hammered, which, I mean, it's not just Coinbase's fault. All of the tech stocks have been hammered about the same way. Get that open while I'm talking to you. But on that news, we saw that Coinbase's stock jumped 15%. So that's a pretty big move. The partnership with BlackRock provides some relief for the biggest U.S. crypto trading platform, whose stock had lost more than 2/3 of its value this year through Wednesday. So Coinbase went public, and it's being traded like a NASDAQ stock, like a tech stock, like cryptocurrencies. It was down by 2/3. I think it was down more than 80%, I think, at one point. I don't have the chart up in front of me, unfortunately. So it got hit, but now it pumped 15% on the news. It says that top BlackRock clients will be able to use its Aladdin investment management system to oversee their exposure to Bitcoin, along with other portfolio assets such as stocks and bonds, and to facilitate financing and trading on Coinbase's exchange, according to a statement on Thursday. So top BlackRock clients, so institutional clients of BlackRock, use BlackRock's system to manage their stocks and their bonds. Of course, that's their traditional investments. And now they're going to be able to also manage their Bitcoin right inside of there. Why is that a big deal? Well, these traditional asset managers, we've been talking about this since 2017. It's like, the institutions are coming, the institutions are coming, the institutions are coming. And everyone's been waiting for it. And it seems like, oh, you're always saying they're coming, they're coming. Well, it takes a long time. When we saw music and movies and books get digitized, it happened really quick. And, the record labels and the movie companies, they fought against that. They didn't want them to get digitized. But they weren't able to stop it at the end because digitizing is better. You can't stop a good idea whose time has come. But when it comes to securities, when it comes to investing, there's laws around that. And the laws are the problem. And so a lot of these big institutions, they're not able to buy Bitcoin for a number of reasons. Their fund's mandate doesn't allow them to. There's not clear regulatory guidance around that. There's not good systems to take custody of it. They're not allowed to custody their assets on their own, so we need institutional grade custody support and things like that. So there's any number of reasons why they can't do it, even though they want to. And so I know it seems like it's taken a long time, but that's how long it takes to change these regulations, these laws. I mean, it takes a long time. But these are big, big steps. Now, does this mean that instantly today it's going to jump? Not necessarily. I mean, Coinbase did 15%. But this is a big deal because, as I said, BlackRock is the largest asset manager in the world. And now all of these big accounts that use their back end will now be able to manage their Bitcoin right alongside their stocks and bonds. It says initially will be only Bitcoin. Oh, and it says also tap into their financing. So now, not only that, they can tap into the financing, which takes loans against Bitcoin, I'm guessing is what they're talking about. So if you don't know, people think that's very weird or strange, or why would the government allow people to take a loan against their Bitcoin? Well, you can take a loan against anything. So you can take your car and go down the street and get a title loan against it. You can get a equity line against your house. And if you have like an Interactive Brokers stock trading account, or even Wells Fargo will give you loans on your stocks, on your equities. And so, of course, you can get loans against your Bitcoin as well. It's just another type of collateral. It says, BlackRock's move deepens the involvement of Wall Street's traditional financial players in crypto and related technologies, even after this year's meltdown in such assets. When you see big moves like this, especially when it comes to Wall Street and investment funds and hedge funds, et cetera, is that they're all trying to one-up each other. And so it can sort of become like this self-fulfilling prophecy where if one of them gets a little bit of exposure to Bitcoin and then outperforms, then all the other ones will be forced to then take action. Then what happens is it becomes a self-fulfilling prophecy. So now more people jump in, which pushes the price up even more, which then forces more people to jump in, which pushes the price up even more. But in the beginning, to try to get a little bit of momentum going, it's hard for somebody to stick their neck out there first. So it's kind of like if you've ever watched that video of like how something goes viral. There's like this video like at a concert, like on a lawn, and one person gets up and starts dancing, and everybody's looking at him like they're some wacko, and they're pointing and laughing, etc. It's very difficult for that first person to get up and just start dancing. But then eventually, like, one more person starts dancing. And then eventually, like, one more. And then before you know it, everybody's up dancing. And so nobody wants to be that first or even the second or third is very difficult. But when you see somebody like BlackRock, who's not just a well-respected, no, we're talking about the largest. Not just the largest. I believe they're larger than the next 5 combined. They're that big. When they come in, when the leader is in, then it's open up for everybody. And so that's why you have to understand how big of a deal this is. I say it deepens the involvement of Wall Street. I think that's an understatement. Like I said, they are not just the biggest. I believe they're bigger than the next 5 combined. So when they come in, everybody comes in. But what it also says is, well, a lot of people go, Mark, Bitcoin's a joke, Bitcoin's a scam, Bitcoin will never work. Look how much it fell. Well, the largest asset manager in the world doesn't agree with that statement. And I know, we all think we're pretty smart, right? Check yourself with that though, right? Because are you smarter than the largest asset manager in the world? Do you have as many assets under management as they do? The answer is no. Obviously, no. They have more than the next 5 combined. And so I'm certainly not saying I'm smarter than anybody. I'm certainly not smarter than them. I do choose to do different things because I'm a different person. I'm an individual. I have different wants, needs, desires, interests, etc. But when some people think that Bitcoin will never succeed because look how far it's fallen down from its high. But then you see the largest asset manager in the world jumping in, then that's a pretty big deal. This says the partnership is a, quote, a validation of the future of Bitcoin and a validation of Coinbase's reputation. The announcement shows sophisticated investors are growing more comfortable with the Bitcoin market. There you go. The market demanded it. BlackRock jumped in. Institutional investors account for about 3/4 or 300 billion of trading volume on Coinbase. And it's about to get a whole lot bigger. Maybe not tonight or tomorrow, but it's coming. These are things you have to watch out for. Fiat currencies. They're dropping like flies, and it's only starting to speed up. What do I mean by that? Well, we're seeing entire countries' currencies collapse, and the nations basically collapse, right? So we've seen Lebanon, we've seen Argentina, we've seen Venezuela, we've seen Peru, we've seen Ecuador, the latest Sri Lanka, and their currency collapsed. They have no money. They can't pay their bonds. They can't import food. And so we're seeing these currencies collapse everywhere. But we have, I think, 30 countries that have double-digit inflation, something like that, where these currencies are losing value so fast. People literally have to get paid daily, right, or they're losing money too fast. And so, in some nations like Lebanon, for example, or Sri Lanka, right, they're seeing 80%, 100% inflation. And when you're in an environment like that, if you're sitting there holding currency and you know that it's losing 80% of its purchasing power, what would you want to do? Well, you'd want to get out of that currency as fast as possible, of course, right? The problem is as those currencies are falling, more and more people get out, which only makes them fall even faster. And so what happens is then nations will put something in place called capital controls. And so they're basically trying to control the capital so it doesn't escape, so it doesn't get out of the system. And so they make it very difficult to buy dollars, which is what most people would want to go to. And so obviously Bitcoin is a solution for that. But the problem is, and again, I'm the first to tell you, is that Bitcoin's in an evolutionary process. So Bitcoin is not the most stable currency. The valuation fluctuates. And I don't recommend anyone to put money into Bitcoin that you need next month to buy goods and services. If you need money for your rent or your food, you probably shouldn't put that into Bitcoin for the next month. I would say put money into Bitcoin that you don't need for the next 3 years. That's kind of the time frame I look at it. And so in these countries, they're not thinking 3 years out. They're just thinking, next week. Bitcoin can help that over the long run, but it doesn't really help it right now today. And so what we're seeing is this rise of these stable coins. So these dollar stable coins, which is basically the same as a dollar, but it moves like a cryptocurrency. We've talked about this extensively. I'm not going to go super deep into what a stable coin is. But what we're seeing is that in Latin America, they're growing really, really, really fast, especially in Chile. In Chile, we can see that it's been one of the most stable economies in Latin America, but now the residents of Chile are turning to stablecoins to protect their assets from recent record inflation and the increasing devaluation of the peso. So again, the currency's losing so much value. So when you're in a currency that's losing value, you're trying to get out wherever you can. And so in Chile, they're turning to these stablecoins. As a matter of fact, we can see that local crypto exchanges have seen a 50% increase in stablecoin transactions in just the last 3 months. As a matter of fact, it says that Per Crypto Market, which is a Chile-based exchange, saw 200,000 users in the country, which is a 50% increase in purchases of the two most commonly used stablecoins, which are Tether, USDT, and USD Coin, which is USDC. And so they're getting a massive amount of adoption there. It says today, stablecoins represent 30% of users' total purchases. And they mostly choose to buy if it is their first time using the platform. So that's a pretty amazing statistic. 30% of users' total purchases are being done with stablecoins. It says that Buddha.com, which in 2015 was the first crypto exchange to launch in Chile, has seen a massive increase in stablecoins. Stablecoin market share on the platform rose from 11% in June to 20% in July. So it's almost 100% increase in just 1 month, which is pretty massive. We see this as a huge trend and something users are taking as an opportunity to buy US dollars easily without having to go to a bank or exchange house. So that's exactly what they're trying to do. Stablecoins' increasing use is tied to Chile's faltering macroeconomic situation. In June, the country's year-to-year inflation rose to 12.5%, the highest record in 28 years. 1 month later, its peso currency hit a record low of 1,000 per US dollar, dropping 3.7% in 1 day. Not good. So I'm not going to get into all the reasons behind Chile. That's not the point of this that I wanted to talk about today. But just talking about the rise of, the collapse of fiat currencies. All fiat currencies will eventually collapse. They're dropping like flies, and we're witnessing it in real time happening today. The dollar will probably be the last one standing, but eventually its value will continue to plummet as well. So I'm not going to go deep into that, but rather the rise of these new type of currencies, these stablecoins specifically. In El Salvador, they announced a new one, and they have a new backed synthetic dollar stablecoin. And this is a little bit different. This one's pretty interesting because typically a stablecoin is where I give you $1 and you give me back a token that's redeemable for $1. And that token, that token that you've given me is always worth the dollar that I gave you. That's why they're stable. It's always stable to that dollar. Now, what the dollar buys me fluctuates, sure, but it's always worth $1. But what El Salvador is doing is a little bit different, and it's not where I give you $1, you give me a token back, and it's being headed up by Galoy. Galoy is behind the El Salvador's Bitcoin Beach wallet. It's an open source platform. It's a financial platform in El Salvador, and they launched a synthetic dollar backed by Bitcoin, and it's called StableSats. Pretty cool. StableSats aims to provide a different stablecoin network and a regular way bank integration. It uses derivatives contracts to create a synthetic dollar backed by Bitcoin and then tied to the US dollar. So it's totally different. It's a synthetic dollar that's backed by Bitcoin and tied to the US dollar. They're hoping that enabling dollars to flow through Bitcoin would help remove short-term volatility price risk, and which is now one of the most significant barriers to Bitcoin's expansion as a means of casual payments. Because, of course, you don't want to put all your money into Bitcoin and have that price fluctuate so much. So StableSats uses a financial technique that BitMEX used. So BitMEX was the #1 derivatives trading exchange for Bitcoin. So it's what BitMEX used, called perpetual inverse swaps. So using perpetual futures contracts to produce the synthetic USD, futures contracts are agreements to buy or sell a specified asset, such as Bitcoin, at a specified future date and price. But because they're perpetual, then they don't expire. There's no future date when they expire. So it's a little bit hard to understand exactly how they work, but if you've ever used BitMEX or an exchange like that, then you're probably familiar with how that works. And so you're basically betting, someone takes the high, someone takes the low of what that is, and they always cancel each other out, and it causes it to be stable. The reason why they think that is a better way to do it there is because now you don't actually have to work with US dollars. When you're using fiat currency, they control the on and off ramps. And so if they can do it without that, they think it's going to be much easier for individual users to be able to jump in to this existing system that's there. And of course, they're doing it in El Salvador, which is the first nation to adopt Bitcoin as a legal tender. However, Bitcoin's not the best money to be used as legal tender because it's so volatile. And so I think joining the Bitcoin with the StableSats could be the perfect combination. And I'm excited to see what happens. That's what I got for you today. Those are the headlines of the week. You're listening to the Mark Moss Show, talking about the decentralized revolution. That's what I got. Hope you enjoyed it. Thanks for listening. Since you've stayed to the end, I know you like this video, which means you're probably going to really like this video right here and this video right here.